Hey guys, how's it going? Welcome to a new video on the channel. Hope you all are doing well. Today we're going to continue with our summaries of business management chapters. Today is the chapter 3.5. All right, 3.5. Right now in this section, the later parts of Unit 3 for business, we tend to have some shorter chapters, some stuff that's pretty quick. A lot of equations and formulas, but it's all useful information. So today's chapter, we're going to go through this quite rapidly. It's really just, we're focusing on two kind of main formulas or two main ratios. All right. So anyway, 3.5 is titled Profitability and Liquidity Ratio Analysis. All right. So this really what it deals with is, the main idea of these ratios are that they're a management tool. They're a way that a company can judge its financial performance. And so the numbers that are used within these ratios and these equations, they all come from the financial accounts. So we've talked about the financial accounts in the previous chapters. If you guys haven't yet seen those videos, you can in the link in the description. There's a playlist with everything. So important to understand that stuff before we get into these ratios. However, so you use these ratios to judge the financial purpose of a business. You can look at the firm's position, their liquidity, which is to say their cash flow. How well are they moving money around? Is there a lot of money just kind of sitting there? How is the financial situation of the business? Are they good at controlling their expenses? How's their profit looking? How is their spending looking relative to what they thought they would be spending, their projections and the budget of the business? That's called variance analysis. And also this helps just to aid in decision making for the business, but also for people who are looking at the business. People who might think, I want to invest in this business. These ratios give you a very good picture of how is the business really doing. And so ratio, you can also compare the ratios. That's one thing they're very valuable for. So you can compare the ratios either historically, that's to say you look at two time periods of the same business and see how are the ratios now and how are the ratios before. Or you can also do inter-firm comparisons, which is within the same industry. You compare two different businesses, let's say Google and Apple, or probably more apt would be Apple and Samsung, for instance. And you see how are the two different companies doing in these various ratios. And this gives you a good picture beyond just what's on financial accounts. These ratios are more specific in what their goal is. All right, so there are two kind of main categories of ratios. There's a few, I said two ratios before, two categories of ratios. Within those, there's each, a variety of different formulas we're going to go over. Do not worry, they're all quite simple. But anyway, so the first category of ratio, the first type are known as profitability ratios. The other type are, as you can imagine, liquidity ratios for the title. So profitability ratios, what these do is they look at profits relative to other figures. These are important to know for a profit-seeking business. Obviously, a nonprofit, you're not worried about this kind of information, but in a profit-seeking business, this is important information. So the first margin, or for the first ratio we look at, is known as the gross profit margin. All right. So this looks at gross profit as a percentage of sales revenue. So gross profit, as you guys might remember, that is quite literally you take in the sales revenue, and then all you do is you subtract out the cost of goods sold, which is all that you had to spend to create that good, to sell that good. An example is if you look at financial accounts, we actually looked at this in the previous video. But for instance, in a company, right, you have your cost of goods sold, which would be things like direct labor, raw materials, packaging. All right. So the things that you had to do directly in relation to the selling of that product to produce and distribute that product directly. And so gross profit is the money you're making once you take out that. Because obviously when you sell a product, you're making a certain amount of money, but a certain amount you've already lost just creating the product. So gross profit is the net that you've made there. All right. The difference between what you sold it for and what you were getting. So all this gross profit margin does is you take your gross profit, you divide it by your sales revenue, and you multiply by 100. And so this is basically a percentage, all right, of how much money you're making off of it. So to give an example, all right, let's say we have a product that we've made $3 million in sales revenue, all right, and $1 million in gross profit. That's to say we spent $2 million in the creation of this product, in the labor costs, so the salaries of the workers and whatnot that were making the product, in the equipment to make the product, in the distribution of the product. All right, so all those things, we spent $2 million on it. We ended up selling and we made $3 million from all the sales. But remember, we have to subtract out those 2 million to get the gross profit, because this 1 million is what the money we've really made. And so then we take this 1 million, divide it by the 3 million, and we multiply it by 100. That's going to give us more or less 33%, 34%. All right, so a third. So that's the margin of how much money did we really make from it. Obviously, the higher this profit margin is, the better. Next, we have the net profit margin. This is doing a similar thing, but with net profit. All right, you're trying to see the percentage of your nets, of your overall, sales earned. The percentage of the sales that you made that were turned into net profit. Remember that net profit is basically the whole list of calculations that you have after gross profit, because what you're doing is now you're taking out things like your expenses, all right, your fixed costs of the business. That's things like rent. That's things like organizational costs, so not directly related to the product, but still business expenses. Also, for net profit, you have to take out taxes on dividends, which are the money you pay to your shareholders. However, for these calculations, you actually don't take into account dividends, taxes, none of that. All right, all you do, you're taking your net profit before interest and tax. That's to say, so your net profit, this is only really a step beyond gross profit, because net profit before interest and tax means you take your gross profit and now you subtract out the fixed costs. And that gives you your net profit before interest and tax. Now, why do we do this? We do this because the net profit before interest and tax is more applicable to things the business can control. Because the thing is, interest and tax, they're not within the control of the business, right? They're things that are outside of the business's purview. And so it's hard to really measure a business's performance if you're taking into account their taxes and everything as well, because they're not controlling the amount they have to pay. And also, if you're subtracting taxes for every business, they're going to be the same. The percentages are the same for every business. So in that case, it isn't really relevant information. It doesn't help you get a better idea. So when we take out that factor, if we stop talking about taxes and interest, all we're talking about are what are the variable costs, right? What were the costs we had to spend to make the product? And what were the fixed costs, the costs the business had to pay for organization, those kinds of things. And so this is really all the costs that business actually controls. That's why we're using this. This is why we're not using net profit purely. We're using it before the taxes and all those things, because we're talking about what can the business control, what costs. Because you guys have seen, we're trying to see what's their expense control. That's part of the purpose of these analysis. And if we're using taxes, something they don't control, well, then that doesn't help us reach that goal. And then, of course, we multiply by 100. So that gives us also a percentage proportion of how much of what they sell becomes net profit at the end of the day. And then our difference, this is another nice little thing, the difference between your net profit margin and your gross profit margin, that represents your expenses, your fixed costs specifically, because that's really the only difference between these. Is your gross profit, you're just taking out the fixed costs as well, and that gets you your net profit for these calculations. And a larger difference between these two margins means you have higher overhead expenses. Overhead expenses, we mean the fixed costs, organizational costs, and those things. And that's worse, because that means if you have a ton of fixed costs in your business, it's hard to be profitable. It's hard to have control. It's a volatile situation, because you already have to spend so much money on fixed costs. All right, and then the next one is return on capital employed, or ROCE, ROS. I don't know how you would say that. There was a joke at my school that most of the kids in my school are Spanish. And so someone read this as if it was a Spanish word, and they said roce. And we all thought that was pretty funny. So if that helps you guys remember it, great. But return on capital employed. So this is your financial performance relative to the capital you invested in the company. The formula for this is net profit before interest and tax. All right, we're doing this for the same reason we do the other one. Net profit before interest and tax divided by capital employed. You guys might remember we talked about capital employed and how that is calculated. And so this is shown as the percentage. This is showing the profit as a percentage of the capital used to generate it. So this is just kind of helpful for us to see. We're spending this much amount of money. We're spending this money to create the product in our business. This is the capital we have moving around. Well, how does that correspond to the money that we're making overall, the net profit that we're making as a business. So it gives us also another good idea of what's the money we're putting into it, what's the money we're getting out of it. It's another way of kind of comparing it. So again, these are complicated formulas, I don't think, but if you guys do have any problems with them, in most cases, actually, I think these are included on the formula sheet for the exams, if I'm not very poorly mistaken. So you guys are going to have these formulas in the exam. They're not complicated. I think you guys can remember them. But in the case you don't, you do get a formula sheet with all this on it. So you guys should be good. All right. So that ends profitability ratios. That brings us to the second part, which are the liquidity ratios. There are also a couple ratios here, and they're slightly more complicated, but also I think quite understandable. So liquidity ratios, this looks at what is the ability of a company to pay its short-term liabilities. Because liquidity, here we're talking about cash flow. We're talking about, can this business move its money around? All right. And so having better liquidity is better because that means you have a better ability to get cash moving where it needs to be, to make sure your expenses are getting paid, things like that. Okay, and so there are two major ratios that we use for liquidity. All right, the first is the current ratio. So this is your relationship between your current assets and your current liabilities. Quite literally, what you do is you take your current assets and divide it by your current liabilities. Done. And this shows basically if a firm has enough liquid assets. Liquid assets mean your current assets. If you have enough current assets to pay your current liabilities, it's pretty straightforward. Because we're talking about these are assets or liabilities that are within a short time period, that are within 12 months. That within 12 months you have this money. It's probably going to go at some point, and for 12 months you have these liabilities that you have to deal with. So saying in the here and now, do you have enough money to deal with all the expenses you're going to have, all the liabilities you have? A desirable ratio for this is key. Desirable ratio is between 1.5 and 2. If you have more than 2, it tends to mean you have too much stock, too much inventory that's just sitting there not being sold, or you have too much stagnant money, because as cash, just pure cash is an asset for business. But if you have so much cash, if you have double the amount of cash as you do have things to spend it on, well, that means you have a lot of cash sitting there that you're not doing anything with. So then the question becomes, well, we need to start using this cash, because why do we have cash here sitting here if we're not going to use it for anything? If this ratio is too low, if it's below 1.5, this means you have too many debtors and too many current liabilities, and you don't have enough money to cover it. And so that can put the firm in a rocky situation, because then it's like you're spending all your money just paying back these liabilities, or maybe you even can't cover the liabilities, and then you don't have money to invest in your own projects and your own things. Okay, and that brings us to the last ratio, the second ratio of liquidity, which is the acid test ratio. And so this looks at the relationship also between current assets and current liabilities, except you just don't include stock. Stock is inventory, all right? And the reason they say this is because stock or inventory can oftentimes not really be considered a liquid asset. It's not movable in the same way that other assets like cash would be, or debtors or things like that. Because in many cases, obviously, stock is what you're selling. It's your inventory. It's what you're selling to your customers, but it's not liquid. It's not manageable in the same way that other types of things are from, an overall standpoint of a business. So all you do for this is it's the same exact ratio. It's current assets divided by current liabilities, except it's current assets minus stocks, right? Current assets minus stocks divided by current liability. You want a ratio here of at least 1-to-1. Less than that means you're unable to pay your short-term debts, but too high means you have too much cash. Because remember, we've taken out stocks. So it just means you have too much cash if you have higher than, have a very high ratio. And of course, this affects many stakeholders. This includes your banks, your creditors, and your investors. The people who are investing in your business because they want to know that you have enough money, that you're covering all your expenses, that you're in a good, stable financial position. The banks who want to lend you stuff, or who you are lending from. Yeah, it's the same thing. Banks that you're lending from, also your creditors, because those are people that you've lended from. And so they want to know, do you have enough money to cover the expenses, the things that you've taken? Because creditors means you've gotten stock for them, you've gotten items for your business on credit from them, and you have to pay that back. So then the question is, do you have enough money to cover that? So really, these are both quite similar ones. The acid test is considered a bit more accurate just because you're really focusing on your liquid assets, because you can't pay things with stock. You can't pay things with inventory. But you can pay things with the cash you have on you and your debtors, which are going to have to give you money at some point in the future. So it's a bit more accurate of a picture of what are your assets that you can actually pay things with. And with that, guys, we've gotten to the end of this chapter. Again, it's a pretty quick and painless one, I think. I've explained it quite in depth, but that's just because I think we got to make sure we have as much clarity as possible. Going forward, there are a few more ratios in the coming chapters, so it's important you guys understand those things. But that's all. I hope you guys have enjoyed this video. I hope it's been useful. If you have any questions, please do leave a comment, and good luck with the rest of your studies. Have a fantastic rest of your day.